welcome back to another episode of Let's Talk Real. I'm your host, Ismaini, and here with me is Carlos. How are you, Carlos?
Hey, Nini, good, and you?
Good. So, in today's episode, we're going to be cracking the code and understanding the loan products that My City Lending offers with Carlos. And in this part one episode, we're going to be going over all the basic loan products, the most common, I should say, that you see for majority of the buyers, the ones that on a daily basis we have it working. And then for part two, we're going to be tackling the non-conforming, not as usual loan products that are available, which I think is still super helpful for people that don't just feed the common boxes, right, Carlos?
Creative financing.
Creative financing. So this one is going to be good for you guys that are independent contractors, or investors that might be looking on different products. So we're going to be covering that on part two, and today is going to be for basically the masses. So let's get started with conventional loan, which I think is the one that we hear the most of, and a lot of people think that that's like the beast of seven heads or whatever they call it, because they think it has to be 20% down in order to
The only way I'm going to buy a house is with 20% down and a 780 credit score, or 800 credit score. If not, I'm not going to qualify.
Yeah, exactly. And that's not the truth. So I wanted to go ahead and let us know, like, what are the qualifying terms for this? What a person needs to do to qualify for a conventional? Why is it better or worse? And what are the down payment requirements?
Okay, so those are all very good questions.
Go back. Qualifying. Let's talk about how can a person qualify for it?
All right, so number one, conventional loans are for more qualified borrowers, overall. Conventional financing is going to take a look at the borrower's overall credit profile, not just the credit score per se.
Yeah.
The 20% is not true.
Yeah.
We have programs that go down as little as 1% down payment on a conventional, with a down payment assistance, of course. Typically, your first-time home buyer is only required to put 3% down conventional. And if you're buying a second primary residence, then which means you're going to be either renting or selling your current home, and then moving into your next primary residence, you would do that with just 5% down, or I have a program that will allow you to do that also with just 1% down. The whole PMI thing, so private mortgage insurance, essentially, when you put less than 20% down, the bank puts an insurance on it that if you don't pay, they get paid.
Yes, so it's basically for the liability that the bank has for lending too much money to a potential buyer. So
Exactly.
anything below 20% will automatically have PMI. But the conventional loan has different grades of PMI.
Right. So depending on how much down payment you're putting down is going to determine your PMI. In other words, the more skin in the game, the less PMI the bank is going to make you pay. Correct. Or no PMI if you put 20%.
Yeah. And that's why the 20%, I think, became such a statement, that people say, oh, you have to put 20%. Well, you do have to have 20% if you don't want to pay PMI, which is the mortgage.
Correct.
So that's why that 20% came to be. But really, conventional loans start as low as 1%, and it goes up from there. And like you said, the qualifying criteria is very differing for different types of down payment. But I would say overall, credit scores usually have to be around the 700s, right? You would say?
Yeah. So in reality, you can go conventional with a 620, but you're just going to feel it when it comes to your PMI if you're not putting 20% down, and you're also going to feel it, on your rate. So that's why, we have, algorithms and strategies that we can implement to help you, increase your score so that you get the most favorable terms, when it comes to conventional financing.
Yeah.
The other cool thing about conventional financing is up to years ago, I think it was like maybe a year or so ago that they switched. Before when you wanted to buy a multi-unit, you had to put, that 20% down. But Fannie Mae announced that you can do it with just 5% down up to 4 units. So before that used to be a big thing where you would only go, if you didn't have too much down payment, you'd have to go FHA because FHA would allow that.
Yes.
Now conventional allows that as well at 5% down.
And that's awesome. So people that are looking to, get started in the real estate world and get investing, but they're buying
the first investment property, they can live in it and rent out the rest. The smartest thing you can do is buy a 4-unit, live on one side, rent out the other 3, live for free, and get anywhere between $800 to $1,000 a month, depending on the rent and the area they're buying for.
Exactly.
Or buying in, sorry.
Yeah. I think the other thing that conventional somewhat stands out in comparison to other loans is that it is the type of loan that is not backed by the government. So
Right.
Therefore, the appraisal that has to happen during the buying process, it's a little more lenient
less strict than all the other loans. That is true.
Exactly.
That is very, very true.
So that's a pretty big benefit.
Yeah, conventional will not worry about certain things that other government loans will worry about.
Yeah. And these little things, like it's really nothing major. I mean, there are some potential major items, but I would say it's handrails, it's carbon monoxide detectors, it's GFCI outlets in the kitchen and bathrooms. So it's stuff like that that is not a deal breaker per se, but that the conventional will not request in comparison to government-backed loans, where they will most likely request those. Like even peeling paint, especially, is a big one for any government-backed loans.
That's correct.
So any other things that you can think of to highlight on conventional?
Conventional loans, you can also go with like down payment assistance and stuff. So there's certain programs that will only allow you to do it if you're conventional.
Okay.
Yep.
And that would be for like first-time home buyers, you're saying? Or
first-time
not?
home buyer, like conventional will have some down payment assistance or closing cost assistance, however you want to look at it.
Yeah.
That will that are property specific, that will allow you to get anywhere between 1.5% to 2% towards your closing costs, but you can only get that if it's a conventional loan. You can't do that on an FHA.
Yeah, exactly. One thing that I know for a fact that it's something to consider, especially when you are a buyer that is, the intentions is to minimize your out-of-pocket, and you're negotiating potential seller's assistance, that we call it, when you negotiate a seller to pay a portion of your costs. With the conventional loans, if you're putting less than 10% down, you are limited, you're capped on requesting only 3%. Yeah. So I think that's the only, factor that someone have to consider when you're buying. If you want to go conventional, but you're looking to get 5% or 6% seller's help, you're not going to be able to do that with a conventional. But that would be when Carlos would run the numbers and the algorithms and see that sometimes, financially speaking, it's better and cheaper for a buyer to not go conventional, but go with one of the backed government loans instead. So I think that's a good segue for us to migrating to one of the first 3 most popular ones, which is FHA loan. FHA loan is a government-backed loan, and there's a difference between government-backed and government guarantee. The only government guarantee loan that is most popular, I would say, is VA, which is the military loan, which we'll talk about it too. But FHA is one of the government-backed ones, and that's why they have a little different criteria when it comes to safety guidelines for the appraisal. But take it away, Carlos. Let us know what the requirements are.
Right. So the biggest thing is FHA, you're only required to put 3.5% down, whether it's your first house, your 8th house, it doesn't matter. If you're going FHA, you're only going to put 3.5% down. FHA will allow you to extend your debt a little bit more. So they will. So something we mentioned about conventional was that conventional, you're usually capped at 50% DTI, which is debt to income, which is how much you make versus how much you owe.
Yeah.
And on FHA, you can realistically go up to 56.9.
There he goes.
Hope my managers don't see this one.
Gotta work some numbers. Things have to make sense, but yes.
You have to finesse it, but yes, you can go all the way up to 56.9% on the back end on your debt to income.
And I'm glad
So
you mentioned that can be like your first, second, and third, because a lot of people have this misconceptions. Another second myth, I would say, the FHA is a first-time home buyer. They see the FH, they think first-time home buyer kind of deal.
yeah,
It is not. You can use FHA many different times.
right.
You also can buy 1 to 4 units, but it's just more commonly known for being a first-time home buyer loan because, again, it allows for a greater debt to
It's a
income.
more lenient loan, and most first-time home buyers aren't like fully prepared to go conventional. A big majority of them, have to go FHA because their mindset isn't quite there yet. So we do what we can to kind of get them there, and then once we do the first one FHA, we prepare people because now they understand the process, they understand all that stuff, and then we prepare them so that they can go conventional.
Yeah.
And that first FHA they got, they'll eventually be able to, after a year or two, they'll be able to rent it out, get some rental income, and then go and buy their next property conventional. And if they claim it on their taxes correctly,
Correctly.
that rental income to help them on the next property to qualify for the next property as well.
Exactly, exactly. And with the FHA, it is always 3.5% down. A lot of people hear the 3.5, they're like, "Oh, is it the interest rate?" No, it's the down payment requirement for FHA. It's 3.5,
Sure.
period. Now, common question that I get: can you put more down payment if you are going FHA?
So yes, you can put more down payment if you're going FHA. Uh, I've had people put, wanting to put 20, 25% down. And I'm like, hey, listen, like at that point, you're better off just going conventional because your loan level pricing adjustments, aren't going to hit you as hard and there's not going to be any PMI. So I've switched people over, with a 630 to conventional because I realized they were putting, 25, 30% down. It just
Yeah.
made sense to not have PMI the whole time.
Yeah. And I think since we are like between conventional and FHA explaining now, I think it's good to highlight that the type of housing that you can purchase with in a conventional loan versus any sort of government-backed loans also can vary. A conventional loan, because it's not backed by the government, has less strict guidelines. It will allow you a buyer to go for many different properties, even if they are not in perfect condition. But with an FHA loan, that is not the case. The house has to attend to some certain safety guidelines and it has to be in certain condition in order to be able to be approved for FHA. So that's why it's so important for a buyer to come to you and get approved first so we can start looking at the appropriate houses so they're not
Right.
wasting their time looking at homes that might not even be eligible for
That they
FHA.
won't be able to qualify because it's just not the type of program that they're approved for.
Correct, correct. And I think I'm going to even bring the example that we just had with a buyer where they're looking at manufactured home. And I think there's a big, like people don't understand that there's different house types, right? So when they see a home and it looks beautiful, they're like, oh, I'm going to buy this home. But the way the home is built does make a difference on the type of financing that you can use to purchase that home. One that is sometimes can be a little bit troublesome is the manufacturer, which means this home was used to be a mobile home at some point, was built to be a mobile home. It may have been permanently attached on a permanent foundation from the beginning, or it was moved at some point. Mobile title got retired. But regardless, the structure of the home is still manufactured, which it is not the same as a stick built. So the banks have different guidelines. You can still purchase using an FHA loan, correct? If you want to
Yes,
go.
you can. Yep, you can absolutely. It does depend on the year it was built and all that stuff. So there are very specific requirements that have to be met in order to be able to buy a manufactured or mobile home.
Yeah.
And you have to see if it's really in the best interest of the client also. Because they're not going to appreciate the same, and that kind of stuff.
Yes, and the foundation has to be done appropriate. Sometimes you need to get engineer structural certifications in order to be able
And it's
to.
more expensive at that point. When you look at it, it's like, all right, well, I might as well not do this because if I have to get an engineer involved, it's going to cost me this. And if I'm already going FHA because I don't have enough money and I need help from the seller,
Exactly.
then
Yes. So, and that's why we're here to kind of guide those buyers and
Yeah, absolutely.
Came
That's why
down
you
from
talk
that
to us before falling in love with a house.
exactly. That my point exactly. But yes, and then one thing also to just differentiate, when I mention mobile homes or manufactured homes that are in a permanent foundation, they must be on a owned lot. So if you ever look at actual mobile homes that are on a lot rent option, those yards, that is not regular housing that we
Right.
consider. And you cannot use any of these loan types that we're talking to you guys today. That is a completely different thing, because basically you're buying a home vehicle. It comes a little bit tighter just like a car, so you cannot finance
It's
it
like you're
correctly.
buying an RV.
Yeah,
That's not
exactly,
moving.
exactly. Very expensive RV, and you're paying lot rent forever. So that is a very different perspective there. But if you buy a home that is in a lot that is owned, and you're purchasing the whole package, and the home itself happens to be or used to be a mobile home that was made permanent, then yes, we can still make it work. But just know that there's different caveat guidelines there. And I know the year was 1976, right? So anything built prior
I
to
believe so, yes.
believe
Let me
it's
see. I have it
like
here.
becomes no go for not even FHA, or I think even conventional have some restrictions.
They do, yep.
So that is it for FHA. So if you are, a buyer that has maybe a lot of that, have not saved up enough money or as much money as you should, FHA might be a better option, mainly because it's 3.5% down. I mean, I've seen buyers with as low as 580 purchase. Not ideal because you're paying a very high interest rate if you're at that low of a
Right.
credit, but it's doable. So it is a very, very flexible loan type. It is just a little more strict when it comes to their home conditions.
Absolutely.
So the next one that we're getting into is the VA loan, and that's your military loan. Dear to my heart because I'm prior veteran as myself, and I used VA for myself, and I have a lot of service members, friends of mine that are using this benefit. It's amazing loan type. So give us some more details about VA and requirements and how does that work for the veterans.
So VA is a really cool loan because if the veteran qualifies, they won't have to pay any PMI, although PMI and VA is called a funding fee, but it's the same thing.
Yeah.
VA is cool because it allows you to finance 100% of the 100% of the value of the property.
So there's no down payment, which is helpful.
Right. And the cool thing is that if the property over appraises, you can go more in, to help, like you can finance all the way up to appraised value, not just your sales price on a VA.
Oh, that's pretty nice.
Yeah.
So you can cover your closing costs, really.
Yep. And then it allows you for 6% seller's assist.
Yep.
And the seller can even pay your credit cards off at closing, give you money besides the seller's assist to pay your credit cards off at closing to help you to qualify for the house. So that is a really neat product for people that qualify.
They allow a lot to happen for VA.
Yeah, there's no minimum credit score, and there is no maximum DTI. It's all based on your residual income, and that's something that we would calculate based on your certificate of eligibility, your DD-214 or your LES, to determine what your residual income is, and then based off of that we would pretty much be able to qualify you. So even if you're above FHA DTI limits or conventional DTI limits, you can still buy a home.
Yeah, exactly. And one thing too to kind of highlight, on paper technically the VA allows up to 4% seller's assistance, but really there's no cap because, like he said, there's other things that you can put and get paid off of closing. So when we say 6, that's a rule of thumb, but really it could even be more. It just depends on what is being paid out of closing. So it's sky's the limit when it comes to VA, as soon as it makes sense.
To an extent.
It makes sense financially, of course. So it is a great product for sure. And like he explained, for people that don't know, the VA loan, you do get 100% financing, and the VA funding fee is based on how long you served, if you served active, if you served reservist. If it's your first or second time using it, that would differ as well. And if you do have
a
disability, you'll be discounted or completely taken away. So there's different things that happen with the VA funding, but the VA funding fee is actually added to the loan amount. It's not paid up for closing costs. So if you are financing $200,000 purchase for the house, you're technically going to be financing 206 because the VA funding fee is going to be added to your loan. So that's how they do it. But then you don't pay any PMI on your monthly payments throughout the loan, which is very helpful for
it's part of your loan amount. That's correct.
Exactly. So it's a very good loan product. If you are a veteran out there and have not yet taken advantage of your VA loan benefit, please reach out. We can definitely help you. If you're paying rent, you are missing out because anybody can buy a home with VA. I've helped many different veterans and active duty, members buy homes with very little money out of pocket. And I mean, really, I've had people make money out of closing. They got their deposit back. So they're not making money, but it was zero money out of pocket basically. So that is very doable. Of course, it depends on housing, the competition, there's a lot of variables, but overall it's doable.
Very true.
So one that we're going to be getting into now is our third most popular government loan, which it is a USDA loan. So I'll give the general guidelines and you go into the financing specifics for this one.
Oh, thank you. How nice of you.
So the USDA is actually it's from PA basically, because it's an agricultural loan developed for Pennsylvania, and it is dependent upon eligibility of area. So you cannot use USDA for just any house. The house has to be in certain areas of Pennsylvania that are considered agricultural. Luckily, Pennsylvania as a whole is a big agricultural country, right? So
a lot of Pennsylvania qualifies for USDA.
A lot of Pennsylvania. So as soon as you're not looking in cities like Harrisburg, Lancaster, York, Hershey, you're basically good to go. So there is some eligibility criteria on the mapping. But other than that, there are some very specific criteria for qualifying for this one. It's not just anybody. So Carlos, I'll let you get into that.
Yeah. So USDA is another one that will allow you to finance 100% of the property value when you're not a veteran, as long as you're not living in the city.
Yes.
There are some specifics when it comes to USDA as far as like they do limit your debt to income, so you can't go as high as you would on a conventional or FHA or VA for that matter.
Hey, there's a limit.
You are allowed to get, I believe, it's 6% seller's assist also on USDA, like FHA, and your income. I gotta check this year. I know last year was like 120,000. This year might be a little bit more, that you can't make more than that as a household.
And I think it depends on how many members you have in the home, and it goes by median income of a certain area.
It goes by the AMI of the area where you're buying, and average median income AMI. Yep.
There's a lot of different little things. It's not like you can say, oh, in general, you can qualify based on this. It's not like that.
That's correct. Yep.
And he does have a max income, like you said, and his household. So even if it just the father is applying for the loan, if the mother's working and the older son is working, we're gonna have to take into account everybody's income. So that could be some people out of qualifying for making too much money, or something like that.
Very, very correct.
Yeah. And it is the only second one that I know of that is like regular financing anyway, that is 100% financing type. So it is very good option for people that are short of funds and are looking in outside of city areas. So I would say if you are one of these people and you're not looking in a city, and maybe you're the sole income producing of your household, this could be a very good potential loan option for you. As soon as you don't have too much debt, because it does have a more strict debt to income ratio.
That is correct.
And same thing applies for house types as FHA and VA. The house needs to abide by the government safety guidelines. So the house will need to be in a certain criteria, meet certain criteria, be in certain condition for you to be able to purchase. And I think that's basically it, kind of matches the other three that we talked about.
Yeah.
Yep.
I agree with you there.
Yeah. So these are the most common. Was anything you want to add to one of them that we talked about today?
Well, let me think. About them, I don't know what else I can add. Typically, conventional loans, listing agents like them because it's a more prepared borrower and more well-prepared borrower, or at least they think it is, but it's not necessarily. You know what I mean? Like,
not always true, right?
They also think there's less scrutiny as far as paperwork goes. But FHA and conventional financing, the paperwork is getting pretty similar now, as far as requirements, documentation requirement and stuff. It's getting like right on par. The only difference really that I'm seeing between FHA and conventional is that is the appraisal, number one. The other thing about conventional is that if there was an appraisal done on the property, let's say, and the deal fell apart for whatever reason, and you can do another appraisal on it, no problem. If it's FHA, the appraisal has to get transferred from the institution that did the appraisal initially, and that appraisal sticks to the property for 6 months. That's correct. Yep. So that was one point I forgot to mention.
Yeah, that can be, I think that's why when you are in a company, it can hurt the property even. So when you are in a competing situation, if someone comes in with a conventional approval, unfortunately, they are going to be a little bit of ahead, even if their offer is the same as the others, mainly because they are conventional. But it is like not necessarily all true. It can be, but it's not all true, because there are some FHA buyers that chose to go FHA because maybe the rate was actually better sometimes as an FHA loan. They may have been able to qualify just as well for conventional, but the rate just looked better on an FHA.
Yeah, or they had like a 660 or 680, which is a decent score, for conventional, not great, but decent. But for FHA, you're gonna get a pretty good tier on your rate, and they can say, okay, you know what, like, I'll take this now. The rates are high anyways right now. And then when I refinance, I'll refinance conventional and drop the PMI.
Yeah, exactly. And the same thing goes for a VA buyer. I feel like sometimes that kind of hurts my heart a little, because some VA buyers could very well go conventional, but they're taking advantage of their VA benefit. And so they should, and they're being overlooked because of the fact that it's a government guaranteed loan, and the appraisals are going to be stricter. So I feel like that we need to change this perspective, especially when it comes to evaluating offers. In the end, it should be about the terms of the offer. And if the house is in decent enough condition, why even bother, or what kind of loan you're getting? You know what I mean? Because if the house is in good condition, that means there shouldn't be anything coming up. Unless that seller specifically knows that, I know something's wrong, and then they know better too.
It's like those Instagram videos. Nobody's gonna know. They're gonna know.
They're gonna know. They're gonna know. That's very true. Okay, so that's a good way to sum it up for part 1 of this series here for loan products, and we're gonna be seeing you guys next week with part 2, where we're going to be breaking it down, the details, and all you need to know about the non-conforming or creative type of financing. So stay tuned. I'll see you guys next time. See you, Carlos.
See you guys. Till next time.